All right, so today we're taking a deep dive into the Indian market.
Okay.
We're using insights from the Crystal Gazing Summit 6.0 to help you figure out how to make some serious money in the next few years.
Sounds good.
We'll be talking about everything from navigating market corrections to uncovering those multi-bagger stocks.
Yes, and we'll also be looking at some alternative investment strategies.
So first things first, the market has been a bit shaky lately.
It has.
The Nifty 50 is down about 15% since September 2024.
Yeah.
I know that can be unsettling for investors, but how worried should we really be about this correction?
Well, the interesting thing about the Indian market is that while we do see these dips, they're often followed by strong growth.
Okay.
Think of it like a roller coaster.
Okay.
There are ups and downs, but the overall trend has been upward.
Okay.
Historically, the Nifty has delivered an impressive 14 to 16% CAGR over the past 2 decades, even with these corrections.
So basically, this isn't a sign to abandon ship.
Right.
It's more like a temporary detour on the road to long-term gains, especially when you consider India's projected economic growth of 6.5 to 7% in FY25.
Yeah, there's a lot of positive momentum driving that growth, too.
Okay.
We're seeing robust private investment, strong consumer spending,
Yeah.
all signs of a healthy economy.
Sure.
In fact, these dips can actually present strategic entry points for savvy investors.
So instead of panic selling, maybe we should be looking for those buy low opportunities.
Yeah.
That brings us to the big question. How do we identify those potential multi-bagger stocks?
Right.
The ones with the potential for 10x returns.
Yeah.
The Summit experts seem to have a framework for that.
Yes, they highlighted the 25-25-25-25 rule as a powerful tool for identifying companies with strong growth potential.
Okay, that sounds intriguing. What exactly does that entail?
It's actually quite straightforward.
Okay.
You're looking for companies that demonstrate 25% sales growth, 25% profit growth, a 25% return on equity,
Got it.
and have a price-to-earnings ratio below 25.
So hitting all four is ideal, but finding companies that consistently meet even 3 of these criteria could indicate a potential multi-bagger.
Right.
Okay.
Now, it's important to note that this isn't a guaranteed formula for success.
Sure.
It's more of a starting point for deeper analysis.
Okay.
But let's take a real-world example.
Okay.
Back in 2015, a company like Bajaj Finance actually met all 4 criteria of the 25-25-25-25 rule.
Interesting.
And if you had invested, then you'd be sitting on some pretty impressive returns today.
So by applying this rule, investors could have potentially spotted a future multi-bagger.
Yeah.
That's pretty compelling. It makes you wonder how many other companies might be flying under the radar right now, just waiting to be discovered.
And that's where individual company analysis becomes crucial,
Okay.
especially in the current market where earnings growth is moderating. Picking the right stocks is going to be even more important.
Okay, so we've got this powerful tool for identifying potential high-growth companies.
Right.
But what about the classic debate between secular and cyclical stocks? How does that factor into our investment strategy, especially in the current market environment?
That's a great question. And understanding the difference between these 2 types of stocks is crucial right now.
Okay.
Cyclicals, as the name suggests, are tied to economic cycles.
Okay.
They tend to outperform when the economy is booming and underperform during downturns.
So they're more volatile,
Exactly.
higher risk, the potentially higher reward.
Think of sectors like commodities, industrials, or even some consumer discretionary companies.
Okay, so they're a bit more of a roller coaster ride, higher risk, but potentially higher reward in a shorter time frame.
Exactly. Now, secular stocks, on the other hand, are driven by long-term trends that are less sensitive to economic fluctuations.
Got it.
They offer more stable growth over longer periods.
Okay.
Think of companies like HDFC Bank or Bajaj Finance again.
Okay.
They've consistently delivered strong returns regardless of the economic climate.
So in a way, they're a bit more like that steady climb we talked about earlier.
Precisely.
Less flashy, but potentially more reliable in the long run.
And we can see this difference play out clearly in the Indian market.
Okay.
Look at the performance of HDFC Bank versus a cyclical PSU bank over the past decade.
Okay.
HDFC has delivered consistent growth, while the PSU bank has been much more volatile with its performance directly tied to economic cycles.
It's a stark comparison and a good reminder that even within the same sector, there can be vastly different growth trajectories.
Right.
So knowing where we are in the current economic cycle is key to deciding which type of stock to focus on.
Absolutely. And while the long-term growth story for India remains intact, this period of moderating earnings growth means that stock picking becomes even more crucial.
Okay.
We need to be discerning about where we allocate our capital.
All right, so we've covered a lot of ground already: market corrections, identifying potential multi-baggers, and the difference between secular and cyclical stocks.
Yeah.
But there's a whole universe of alternative investment strategies out there that we haven't even touched yet.
Yes. And these strategies can be particularly relevant in a market environment like the one we're in right now, where volatility is the new normal.
Sounds like we need to explore those in more detail. Let's dive into those alternative investment avenues in the next part of our deep dive.
Sounds good.
Okay, so we're back and ready to jump into those alternative investment strategies you mentioned.
Okay.
I'm particularly intrigued by this idea of long-short investing.
Yeah?
It sounds almost counterintuitive, betting on stocks to go down.
Yeah.
Most investors are solely focused on finding the next big winner.
Right.
So how do these funds actually identify companies that are likely to underperform?
Well, it involves a deep dive into company fundamentals,
Okay.
industry analysis, and even understanding broader macroeconomic trends.
Okay.
Essentially, they're looking for companies with weaknesses that the market might be overlooking.
So they're looking for red flags.
Exactly.
Yeah.
For example, a company might appear to have strong revenue growth,
Okay.
but a closer look at their balance sheet could reveal unsustainable debt levels.
Okay, so it's about finding those red flags that others might miss.
Exactly. And by shorting those stocks, these funds can potentially generate returns even when the overall market is falling.
Okay.
Let's say the Nifty Y drops 10% in a given year,
Okay.
but a long-short fund successfully shorts a few companies that decline by 20%.
Okay.
They've essentially outperformed the market by 10% on that short side alone.
Okay, that makes sense. So it's not just about profiting from falling stocks,
Yeah.
it's about strategically managing risk and generating returns regardless of market direction?
Precisely. And to give you an idea of how this plays out in real life,
Right.
let's look back at 2020.
Okay.
Remember the market crash triggered by the pandemic?
Yeah.
Well, the Nifty experienced a significant drop.
Right.
Several long-short funds in India actually managed to generate positive returns that year
Wow.
by successfully navigating the volatility.
So they not only weathered the storm, they actually came out ahead.
Exactly.
That's a strong argument for including the strategy in a diversified portfolio.
Absolutely. And it's particularly appealing for those in higher tax brackets as an alternative to traditional fixed income investments,
Okay.
which often struggle to beat inflation.
Now, I know that whenever we talk about hedge funds or alternative strategies,
Yeah.
there's always this perception of high risk and complexity.
Sure.
Is that a fair assessment of long-short funds in India?
Not really. The Indian regulatory environment specifically, SEBI has implemented guidelines to protect investors.
Okay.
Leverage is capped at 2x, for instance, which mitigates some of the risk.
So there are safeguards in place. It's not the wild west of investing that some people might imagine.
Exactly. And that makes long-short funds a more accessible option for investors looking to diversify and potentially enhance their returns.
All right, so we've got long-short strategies on our radar. What other alternative investment avenues did the experts at the summit highlight?
Well, one area that's garnering significant attention, particularly among sophisticated investors, is the world of private equity and private credit.
Private equity, that sounds like the domain of venture capitalists and high net worth individuals.
Yeah.
How does that apply to the average investor?
It's true that private equity has traditionally been more accessible to larger investors.
Okay.
However, the landscape is changing, and there are now more avenues for retail investors to participate.
Okay.
The key takeaway here is that a significant portion of value creation happens before companies even go public.
So by the time a company goes public through an IPO, much of the early growth has already happened.
Precisely. And securing allocations in private equity can be a key factor in building a substantial portfolio.
Okay.
It allows you to tap into that early stage growth potential.
But isn't private equity incredibly risky? I hear stories about investments going sour, companies failing, and investors losing everything.
It's true that private equity carries inherent risks just like any other investment.
Okay.
However, it also offers the potential for outsized returns.
Got it.
The key is to be diligent in your due diligence. Look for funds with strong track records, experienced management teams, and a focus on robust corporate governance.
So it's not just about chasing the hottest startups, it's about making sure those investments are built on a solid foundation.
Absolutely. Now, alongside private equity, we're also seeing growing interest in private credit.
Okay.
This involves lending money to companies,
Okay.
but not through traditional bank loans or bonds.
Okay.
It's typically done through specialized funds or platforms.
Okay, so how is private credit different from just investing in corporate bonds?
Well, private credit often focuses on companies that might not have access to traditional financing options,
Okay.
either because they're not large enough
Got it.
or they operate in sectors that banks are less comfortable lending to.
Okay.
This means that the yields on private credit can be higher compared to traditional fixed income products.
So potentially higher returns, but what about the risks?
It's important to remember that private credit is illiquid,
Okay.
meaning you can't easily sell your investment like you could with a publicly traded bond. However, it also offers several advantages.
Okay.
Private credit funds often target investments that generate steady cash flows,
Okay.
which can provide a level of predictability.
So it's about finding a balance between risk and return.
Right.
And with private credit, you're essentially betting on the ability of these companies to generate consistent cash flow to service their debt.
Exactly. And for those in higher tax brackets, the tax-efficient nature of private credit can be a major advantage.
Okay.
It can be a compelling alternative to traditional fixed income investments, especially in an environment where inflation is eroding the purchasing power of fixed returns.
Okay, so we've got long-short strategies, private equity, and now private credit.
Right.
It seems like there's a whole world of alternative investments out there that most people aren't even aware of.
Yeah.
But what about the traditional stock market? Are there still opportunities to find those elusive multi-bagger stocks in the listed space?
Absolutely. The stock market is constantly evolving, presenting new opportunities for savvy investors. Remember those criteria we discussed earlier, the 25, 25, 25, 25 rule?
Yeah.
Those principles still apply when searching for multi-baggers in the listed space.
So we're looking for companies with strong revenue growth, high profitability,
Right.
and a return on equity that indicates efficient use of capital.
Exactly. And while large cap stocks can offer stability in dividends,
Yep.
the experts at the summit highlighted the potential of mid-cap and small-cap segments, especially after the recent correction.
Okay.
These companies often have higher growth potential.
But isn't that where the risk also increases?
Of course. But that's why thorough research is paramount.
Sure.
You need to understand the business, the management team, and their competitive landscape.
Okay.
Remember, even within the listed space, it's about being selective, not just blindly throwing darts at a stock board.
So it's about finding that sweet spot, high growth potential,
Right.
but with a solid foundation and a management team you believe in.
Precisely. And it's not just about identifying the right companies, it's also about understanding how investment strategies themselves are changing.
Okay.
We're seeing a shift towards more active management, with fund managers deploying capital more quickly and holding on to quality stocks for the long term.
So patience and conviction are key.
Right.
Don't get swayed by short-term market fluctuations. Focus on the long-term potential.
Right. And speaking of evolving strategies, we can't ignore the growing influence of factor investing.
Okay, I've heard that term thrown around, but I'm not entirely sure what it means. Can you break down factor investing for us?
Essentially, it's a quantitative approach to investing
Okay.
that attempts to identify specific factors or characteristics that can drive stock performance.
Okay.
Think of things like momentum value or quality.
So instead of picking individual stocks based on traditional analysis, you're betting on these broader factors.
In a way, yes,
Mhm.
but it's not as simple as just plugging numbers into a model and letting it run on autopilot.
I was just about to ask, isn't that what quant investing is all about?
There's more to it than that.
Okay.
While quantitative models are used to identify and exploit these factors,
Okay.
it's not a static process. Market conditions change, investor behavior shifts, and new factors emerge.
So it's not a set it and forget it approach.
Exactly. It requires constant adaptation and refinement.
Okay.
The recent market correction has actually been a bit of a reality check for many quant investors,
Okay.
highlighting the limitations of purely systematic strategies.
So factor investing can be a powerful tool, but it's not a magic bullet.
Precisely. It's one piece of the puzzle.
Okay, we've covered a lot of ground here. Alternative investment strategies, the ins and outs of private equity and private credit, the changing dynamics of the stock market, and even the complexities of factor investing. But before we wrap up, I'm curious to hear your thoughts on the overall market outlook. What's the next big shift we need to be prepared for? So we've explored all these different investment strategies, from those classic stock picking methods to some of those alternative avenues that are gaining traction. But before we wrap up, I'd love to get your take on the overall market outlook. What are some of the key trends shaping the Indian investment landscape, and what should we be paying attention to as we navigate the next few years?
Well, one of the most significant shifts in the Indian market has been the rise of domestic investors, We're seeing really strong participation from mutual funds, insurance companies,
Yeah.
and of course the ever-growing number of individual investors.
Right.
This has actually made the market more resilient in some ways.
That's interesting. So you're saying we're less reliant on foreign investors
Yeah,
and their whims, which could make us less vulnerable to those global shocks.
exactly. I remember back in 2013 when the uh, taper tantrum hit emerging markets.
Yeah.
India was significantly impacted then, partly due to its reliance on foreign capital. Today, the situation is different. The increasing participation of domestic investors is creating a buffer against those external shocks.
Okay, that's a positive sign. It indicates that the Indian market is maturing and becoming more self-reliant. But beyond this shift in investor demographics, are there other structural advantages that make India an attractive investment destination?
Absolutely. India's political stability, a robust financial system, and improving corporate balance sheets are all factors that stand out, especially in a world that's grappling with, geopolitical uncertainties and economic headwinds.
Those are some pretty compelling factors. It seems like India is well positioned to weather the global storms, but what does this mean for investors right now? I mean, we're in the midst of a market correction and valuations are still volatile. Is this a time to be cautious or are there opportunities to be found?
Well, while market corrections can be unsettling, they often present opportunities for long-term investors. Valuations have become more reasonable, particularly in the large cap space. This could be a chance to accumulate quality stocks at a discount.
So, a bit of a silver lining to this period of uncertainty.
Precisely. But as always, selectivity is key.
Sure.
Don't just buy into any stock, because it's down the game. Focus on companies with strong fundamentals, a track record of profitability, and a management team you trust.
Those are timeless principles, but even more crucial in a volatile market. Are there any specific sectors that are looking particularly attractive right now?
Well, as India transitions to a more domestically driven growth model, certain sectors stand out. Banking and financial services continue to be a solid bet. They benefit from increasing financial inclusion, rising credit demand, and the government's push towards digitization.
So the classic India growth story still plays out in this sector.
Yes. And consumer discretionary spending is another area to watch. As incomes rise and aspirations grow, sectors like automobiles, consumer durables, and even travel and leisure are likely to see increased demand.
These are all sectors that directly benefit from a growing middle class and increasing disposable incomes. It aligns with that broader narrative of India's economic transformation.
Exactly. But beyond these traditional sectors, there are some exciting emerging themes to keep an eye on. Green energy, for instance, is becoming increasingly important. India is committed to achieving its renewable energy targets, and this will create significant opportunities in areas like solar power, wind energy, and electric vehicles.
So aligning your portfolio with these sustainability goals could be a smart move.
Absolutely. And another theme to watch is the revival of private sector capital expenditure. We're seeing companies invest in new factories, expand capacity, and modernize their operations. This indicates confidence in India's long-term growth prospects.
That's a powerful signal. It suggests that the corporate sector is gearing up for the next phase of growth.
Yes, and it's not just about traditional industries. The digitalization of the Indian economy is another mega trend that will continue to create opportunities. E-commerce and fintech, digital healthcare, and even areas like artificial intelligence and data analytics. These are all sectors that are poised for significant growth.
So much to consider. It's clear that the Indian market is dynamic and full of opportunities, but it also demands a discerning eye and a long-term perspective. We've covered a lot of ground in this deep dive as we wrap up. Is there a final message you'd like to leave our listeners with?
I think the key takeaway is the next bull run in India is a matter of when, not if, the fundamentals are strong, the growth story is compelling, and the investment landscape is evolving to offer a wider range of opportunities than ever before. The key is to be prepared. Stay informed and ensure your investment strategy aligns with your long-term financial goals.
Well said. I hope this deep dive has equipped you, our listener, with the insights and perspectives you need to navigate the exciting world of Indian investments. Remember, it's not just about chasing returns, it's about building lasting wealth. As you continue on your investment journey, stay curious, stay informed, and never stop learning. Thanks for joining us on the deep dive.